Have you ever looked at a company's books and seen them spend a huge chunk of cash, but then their profits barely even budged? It feels like it breaks the rules of math, right? Well, today, we're going to solve that exact puzzle. We're diving into a really crucial concept called the deferred expense. Let's get right into it.
So picture this. Your business pays $12,000 right now for a full year of insurance. That cash is gone from your bank account, but when you look at your profit for the month, it's only down by $1,000. How is that possible? Well, the answer gets to the very heart of accrual accounting, which is a system designed to give us a much truer, more accurate picture of how a company is really doing over time.
So here's our game plan. We're going to start with the basic idea, then we'll get into the logic behind it all. We'll even look at how this can be manipulated, which is pretty interesting. We'll check out how the rules can change around the world, and we'll wrap up with how you can use this knowledge to become a much sharper financial analyst.
Okay, so the absolute best way to think about this is with a simple analogy I like to call the cost waiting room. When a company pays for something that's going to benefit it down the road, that cost doesn't just immediately slam into its profits. Nope. Instead, it goes into this little holding area on the balance sheet, basically just waiting for its turn to be counted.
So what is a deferred expense, officially? It's simply a cost you pay now for something you're going to use up later. That $12,000 for insurance, it isn't just gone, it's actually been converted into an asset. You can think of it like a voucher or a prepaid gift card for 1 year of insurance coverage. It's something valuable the company now owns.
This table here really helps clarify the timing of everything. Just look at that top row for deferred expense. The cash goes out before the benefit is received. And that's the key. It's the total opposite of an accrued expense, where you get the benefit now and pay for it later. Just understanding that simple difference in timing is going to help you get all of these concepts straight. So why even bother with this waiting room in the first place? I promise it's not just to make accountants' lives more complicated, it's actually all based on a really fundamental principle that makes sure financial statements are fair, accurate, and truly show what's going on in the business.
It's called the matching principle, and the idea is actually pretty simple. You have to match your expenses to the revenues they helped you earn. So if that insurance policy helps your business run for 12 months, its cost should be spread out evenly over those 12 months. If you just dumped the entire cost into January, it would make that month look awful and the other 11 months look artificially profitable. You'd get a completely warped view of your company's performance.
The whole process follows a really simple three-step life cycle. First, you make the payment, which creates an asset. In our case, prepaid insurance. Second, as time passes, you consume the benefit. 1 month of that insurance coverage gets used up. And third, the cost for that month, our $1,000, gets moved from the asset on the balance sheet over to the income statement as an expense. That's what reduces that month's profit.
And this slide right here shows you the actual mechanics of how the money moves. On January 1st, over on the left, it's just a simple swap on the balance sheet. One asset, cash, is exchanged for another asset, prepaid insurance. Notice your profit is completely untouched. But then, at the end of the month, on the right, $1,000 travels from that prepaid insurance asset over to the income statement where it becomes an expense. And this happens every single month like clockwork until that asset is all used up.
Now, while this system is designed for accuracy, it also creates an opportunity for some serious manipulation, because deciding what really counts as a future benefit involves human judgment. And where there's judgment, that judgment can be abused to artificially pump up profits or, in the worst cases, to commit straight-up fraud.
The WorldCom scandal is the textbook case of this taken to an insane extreme. What they did was they took billions of dollars in just regular, everyday operating costs, things like fees for using other companies' phone lines, and they illegally classified them as long-term assets. By basically hiding these massive costs in that waiting room forever, they turned a colossal loss into a completely fake profit. It led to one of the biggest and most infamous accounting frauds in history.
So how can you spot this kind of trouble? As an analyst, you got to look for red flags, like the ones you see here. A sudden change in policy, for example, is a huge warning sign. Or let's say a company's assets are ballooning, but its sales are flat. That's a declining asset turnover ratio, and it might mean that costs are being hidden away on the balance sheet. These are all clues that a company might be deferring its costs a little too aggressively, just to make their short-term profits look way better than they actually are.
But outright fraud isn't the only complication. To make things even more interesting, the rules for what actually counts as a deferrable cost, they aren't the same everywhere. The two main accounting standards in the world, US GAAP and the international IFRS, actually have some pretty important differences.
A great example is research and development costs. Under US rules, you pretty much have to expense them right away because it's just too hard to guarantee a future payoff. But under international rules, if a project meets certain very strict criteria, those development costs must be treated as an asset. So what does that mean? It means two identical companies, one in the US and one in Europe, could report wildly different profits and asset levels purely because of this one little difference in the rules. It's kind of crazy when you think about it.
So after all that, what is the big takeaway here? Well, understanding deferred expenses is like getting a new superpower. It's like having a financial X-ray. It gives you the power to see beneath the surface of the numbers that companies are reporting to the world.
This isn't just some dry academic exercise for accountants. It's a fundamental concept that directly shapes the very numbers we all use to decide if a company is a success or a failure.
And here's the bottom line. Knowing how a company handles these deferred costs lets you judge the quality of its profit, not just the big headline number. Is that profit real? Is it coming from healthy operations that generate cash? Or is it being artificially inflated by aggressively pushing today's costs into tomorrow? This is the critical question you can now start to answer.
So the next time you look at a financial statement, don't just stop at the profit number. Look deeper. Go to the balance sheet, find that cost waiting room, and see what's really inside. Because what's in there can be the difference between a company that's truly successful and one that just looks that way on paper. Which leaves one final question for you. Will you be looking at the profit or the quality of that profit?